quickly answer that before I launch into the last part of the session. And yeah, James, if you move money to pension at age 60, say, can you reconvert it to get a lump sum on retirement age 65? Yes, you can. Yep. If, for example, you move your money to pension phase, at a latter point in time, or as soon as you satisfy a condition of release, you have full access to it again, if that makes sense. So, say for example, you're 60 but you're still employed, you move your superannuation fund to pension phase, but because you're still employed, you haven't satisfied a condition of release and you can only access 10% of your fund each year. But then as soon as you satisfy that condition of release, you've got full access to it and you can draw down lump sums. And that might be 65, or it might be if you retire at 60 or you change jobs, for example, at age 62, it might be at that point in time that you can draw lump sums from it. Or one strategy that we haven't covered off, and I think it relates to one of the questions, and so I might address it then. It's in relation to selling assets outside of super and how you can contribute money to super to save tax. It's called deductible contributions to offset capital gains tax. So if you're selling an investment property and that triggers a gain or a capital gain, then you can contribute some funds to super to reduce the amount of tax you pay. It works very similar to the salary sacrifice example, but there's a few different rules that are around it. But it basically enables you to reduce tax when you're selling assets, and it can be very useful. Binding death nominations. So superannuation doesn't form part of your estate, so it's important that you tell the trustees of your super fund, in this case Christian Super, you need to tell them where you want your superannuation money to go in the event of your death, because your will doesn't specify it. It actually needs to be specified separate to that. And you can make a non-binding nomination. I think on an application form, you can make a non-binding nomination, which means that the trustees on the event of your death will consider what you've nominated, but they don't have to actually pay it in that way. If you make a binding nomination, it's valid for 3 years, and the trustees are obliged to pay your superannuation out as per you specified in your binding nominations. Now, it's important to make that a financial dependent. So generally you have it either going to spouses or your estate. So because what happens is you pay tax on the money, 16.5% tax on some portions of your superannuation money when it's paid out to a non-financial dependent. So generally you make it either your binding nomination out to a financial dependent or to your estate. And then if it goes to your estate, then it's your will that then directs where the money should go then. So that's just a sort of a concluding comment there. Now we're going to move into questions, and what I'll do for starters is I'll just walk through these questions that people registered when they or entered when they registered for the webinar. I'll walk through those. There's about five pages, but we might be able to cover them off quickly, and then I'll just open it up for further questions. I'll stay online as long as you keep on asking questions, and if you like, I can open it up for audio questions as opposed to having to type them in as well. So we'll see how we go. I'll just plow through these ones so that we cover them off. Royston asked, do I need another life insurance policy? Really, without knowing your circumstances, I don't know, but generally you should have those level of cover. As you're younger and got obligations like mortgages and children and dependents, then you generally need more insurance than later on in life when you generally have your mortgage significantly paid off or paid off, and your children may be independent. So that's a general rule. But life insurance, you should have potentially, and now this is only a rule of thumb, but 12 times what the income you would be replacing. So if your income is $50,000, it's a good level insurance cover. If you wanted to substitute that money is 12 times that, or $600,000 in insurance cover. So, very general rule of thumb. John asks, how do I make the most of investment options in terms of distributing my money between them? Yeah, good question. So Christian Super have 5 investment options, ranging from Australian and international shares in the Ethical Shares Fund, which is the highest risk investment, to cash, which is the lowest risk investment. I do another webinar later in the year about investment options that go into this in a lot of detail. But basically, they're already, dependent on how much risk you want to take, they're already specifying or working out a distribution of assets that are going to get you the level of return and risk that you need or are comfortable with. One thing that Christian Super is moving towards is being able to have 2 options within your super fund. So rather than just having one option of, say, ethical shares or ethical balanced or ethical growth, they'll enable you to have 2 options. So you can have ethical shares and some cash as well. Now, I don't see there's much benefit in holding, say, ethical balanced and ethical growth, because really that just means you've got a portfolio that's slightly between the 2 of them, and that doesn't really provide a great deal of benefit. Where I see the benefit of being able to have 2 investments in your super fund is, particularly when you're in pension phase, is being able to hold, say, 2 years of your pension payments in cash. So say, for example, you're paying out $20,000 a year in pension payments, then holding $40,000 in cash and then investing the rest means that for 2 years you won't have to touch those other investments. So if the market goes down, it means that you won't have to actually touch them. You'll be able to wait for the next 2 years to see them rise again. So if that was the scenario in the global financial crisis, you wouldn't have had to have sold out of your fund. You would have just let them go and you would have seen them come back up in value again, because you're drawing on your cash balance. Samuel asks, how do you go about trying to find a super fund? Now, I think this must be relating to a lost super fund. So there's an ATO website. If you just search on the Google Lost Super, and you've just got to put in your tax file number and your date of birth or something, and it just specifies if you've got any superannuation funds out there that you didn't know about. Ian, how much super should we aim for in retirement in 2021? Great question. There is a retirement planning webinar that I'm doing in July that addresses this specifically. But you can use that same rule of thumb if you were totally self-funded. You could use that same rule of thumb that I talked about within life insurance, where it's 12 times your income requirement. So if you need $50,000, then it's 12 times that, or $600,000 in capital. But generally, people don't need that much because of 2 reasons. One, they get some government age pension that subsidises the $50,000, and they eat into their capital over time, so that by the time they reach their life expectancy, they're basically eaten into the majority of their assets. So probably need to address that in that retirement planning webinar. How to calculate the amount of salary sacrifice and account redrawing to reduce tax and end up with the same net? Yeah, sorry. Thanks for that question, Sue. That's a good one. We haven't got a calculator that works. Well, I've got calculators that I use through my business, but there's not a calculator that's available on the site that actually calculates this for you. You generally need to go through the advice process, but you can crunch the numbers. We can crunch the numbers for you, but we just charge you for that. It's a matter of just crunching the numbers. Stephen asks how to make an after-tax contribution and make sure it is not taxed at 15%. That's all just about being clear when you make the contribution and telling Christian Super or whoever your fund is to say that it's a member contribution, or what we call a non-concessional contribution. It's really just being clear about it. You can change the type of contribution if it's within the same financial year. Just got a question coming up from John. Thanks, John. If we were to invest, if I were to change investment options online, do they take effect immediately? No, they don't. There is a delay. I'm not sure of the delay, but I think it's like a week or so. You could call the help desk and they'll clarify specifically, but there is a delay. So it's really hard to, if you see the market drop and you want to time getting in and out of the market, then it's not particularly effective. Another point, perhaps relating to your question earlier, is that there's this study from a group of academics by the name of Brinson, Biebauer and Hood, and they looked at where return comes from, and they looked back at 100 years of mainly US data, I think it was, but it applies here as well. But basically looking back on the data and saying, where's return come from? And identified that 94 to 96% of return comes from your asset allocation, and then 4% comes from stock selection, so picking the right stocks, and then 2% of your difference in the return comes from market timing. I'm not sure whether I mixed those up, but it's basically those very small percentages. 4 to 6% of your return relates to market timing or stock selection. So the message there is basically that study was reinforcing the fact that it's very difficult to get the timing right of getting in and out of the market. Generally, you're best off continuing to dollar cost into the market, so continue to put money into the market over time, and then you get a lower average cost. And same thing, drawing money out, do it over time, and then you're averaging out of the market as well. Hopefully that's answered your question. Sue asked what the cost for my services are. In terms of the initial consultation, it generally takes about an hour and a half, and it costs $220. And then basically we quote you what it would cost to put the advice together, to give you personal recommended advice. And basically what we try to do there is, a comprehensive plan costs a couple of $1,000s. But if we can focus on one particular area that's to meet your needs, then we can do that for a fraction of that. So basically we estimate how much time it's going to take, and then charge sort of an hourly rate on that.